Welcome to Tradiers, the Traders. Bobby, I was just thinking, like on Michael Farr's podcast, he goes, "Welcome to the Farcast." Should I be more dramatic in our intro? Welcome to Tradiers, the Trader's Edge. I'm Jim Uriel.
I mean, knowing you as long as I have, you're plenty dramatic, man.
Exactly.
You aren't calm at all.
No, I'm not.
As evidenced by the story you told me about today.
Oh, God. Can I tell that story or no?
Yeah, of course you can.
There is still a trading floor at the Chicago Mercantile Exchange. About 300 of us trade short-term interest rate options, and I'm on that trade. Today, for the first time in my 37-year career, security came ostensibly to escort me out because I was in the midst of a tantrum where I was trying to fight everybody. And when they got there, these guys are all our buddies. I mean, we've known them forever. And I'm like, no, I'm fine. And they had to stay there for like 5 minutes saying, "Are you sure you're fine?" Yeah, totally. Whatever, it happens. Today was CPI. Tensions run hot. You saw that number. What did it say to you?
CPI told me a little. It basically, I think obviously the key to it was the month-over-month unchanged reading.
Bingo.
So that is the first time in 400 years that we have not had a month-over-month increase in consumer prices. Right. That was the headline number. I would argue, without having broken it down, it's probably mostly crude oil. Crude oil had a pretty dramatic, it's been at a down channel since April.
But it's come back a bit. Yeah.
Yeah, but it's kind of like at the top end of it now, trying to break out of it. And today, I would argue that it broke out of it. But so that was the part that everybody hung on to and clung to. But we also had the FOMC meeting, and I want to kind of ask you, before I give my opinion, what you thought of that.
So I thought it was very, very interesting. When you go back to last October, when the data was starting to get better, but Powell came out and gave a speech where it sounded like he wanted to ease, despite the fact that the numbers were getting better. Now the numbers opened the door for him to ease, and then he kind of took one ease away. He said the FOMC predicts one ease by the end of this year. I was surprised by that. And one thing, the biggest takeaway from the presser was when he said he has reason to believe, I might be wording this wrong, that the data from the labor market may be overstating the strength of the labor market. Spoiler alert, yes, it's overstating the strength of the labor market. These are all side hustles, second jobs, third jobs. Full-time jobs are down. Full-time jobs imply a career and a path to a career. Side hustles and part-time jobs are getting by. So we look at this labor market and say, oh, a bunch of people are just struggling to get by instead of starting careers. That's not strength to me.
Yeah, one of the things that struck me that was funny. So the SEP is really what went down to one rate cut, right?
Yep.
Powell has said over the last few meetings that, we don't know when the rate cut is coming. I'm paraphrasing, of course, but he said, a cut is more likely the next move, but we don't know when it's coming. Here's one thing he said in response to a question. No one on the committee takes from or brings to this a particular rate path. And by this, he meant the SEP, the Summary of Economic Projections, which is all the same thing as the dot plots.
The dot plot, right.
How do you not bring a rate path to a rate prediction? How do you not bring an assumption of a rate path? You're looking at the data and you're saying, well, based on this data, my summary or my prediction is that this is where we're going to be. That by definition is a rate path. I lost you. So I'm going to finish here by saying the Fed's plan, another thing he said, the Fed's plan is not to wait for things to break and then fix it. And then something you and I have said over and over again, Jimmy, is that you can't go and look at any sort of Fed cut cycle or hike cycle and didn't say that they broke something first, except 1995. That's the only time you can ever point to. And something they did in 1995 is they started cutting. They cut 75 basis points. So maybe that's what they're looking at right now. We don't have you yet. So we're going to have a guest today, Bret Kenwell, who is a technical strategist at eToro. So let's just go ahead and bring him in while Jim works on his technical difficulties. There he is.
Hey guys, how's it going?
Good. How are you, man?
Good. Thanks for having me back.
Yeah. So while Jimmy works on these, oh, look at that, Jim, you're muted. I could see from my screen that you somehow muted yourself or somebody muted you. There you are.
Myself. Am I back?
You're back.
Brett, technology is my good friend. It doesn't ever throw me off my game and make me sweat profusely when it starts to go bad on me. Because like I'm a control freak, and so it's something I just can't control, and it bothers the crap out of me. How are you, Brett?
I'm doing good. It's been a busy one with the double whammy today.
How about it? Yeah. Did you hear my story about almost getting carted off the trading floor?
Yeah.
I'm embarrassed, actually. I really was. Like, I turned red when I saw 3 security guards standing around me going, "Are you okay, Jimmy?" Yeah, no, I'm fine. It's everybody else who's wrong. Anyway, at eToro, let's get back to you. You are the guest. At eToro, you guys recently did a pretty broad survey of options users in the retail space. What were the results of that survey that you think are noteworthy?
Yeah, there's a couple things that really jumped out to me. I think the first one is sort of how the retail investor is evolving with options. Last time we were on the show, we talked about how options were such a good way, really, for us to gain exposure, but also limit our risk. Right? We could nail down exactly how much we were going to risk in a scenario, and that was that. In the worst case scenario, we knew what we were risking, and I think if you go back, 4 or 5 years ago, so many retail investors, traders that were using options were doing it in a more of a YOLO type of fashion. They were just piling into names, GameStops and AMC's and that sort of thing, or even just we had at the end there that bull market really just kind of took off and had this sort of like a volcano, like this beautiful, just destructive ending. And I think a lot of retail investors used options to ride those big gains because a lot of them had never really used them outside of what essentially was a raging bull market. And then they found out very painfully what happens when you try to use them the same way in a bear market. So I think the thing that stuck out to me from the survey was how many investors had actually stuck around since COVID-19 and from the pandemic days. I think it was about 62% have not only continued to trade options, but actually increased the amount of options that they've traded. From a retail's perspective, that kind of surprised me that more people weren't scared off by that, basically how it ended. Whether it was the short squeeze bonanza or just the bear market in general. So that really stuck out. Another one that really stuck out to me was the prevalence of credit spreads over basically any other strategy, long calls, debit spreads. I would consider a credit spread, it's not exactly highly advanced, but I would consider it a more advanced strategy certainly than just buying calls or puts. And to me, that kind of showed a better balance of risk, and more of a looking for a base hit rather than continual home runs. And so that kind of impressed me from the retail trader's perspective.
I love all of that. So basically what I'm hearing you say is that in the past, I think that people thought of options as this highly leveraged cowboy strategy, which it can be, but it doesn't have to be. It's actually, the three of us know well that it is a more powerful risk mitigator than it is a huge risk adder. And I always give, with options and with futures, in my stump speech, I always talk about how I think they're like the power tool in your garage. If you know how to use it properly, the garage gets built quickly. If you don't know how to use it properly, someone's going to lose a thumb. So you're thinking we've broken down those walls and people are starting to understand the powerful tool that they are now.
I mean, there's always going to be new entrants to the game, and they're going to have to go through the same learning curves that we've all had to go through. And inevitably that's going to be, losing money. But the reality is that they're getting into it. They're sticking with it. And I think you see that overall in just the options data in general. I don't have it offhand, but we know that options volume have been increasing year by year. It keeps getting bigger and bigger. And part of that is the introduction of shorter dated options and 0 days. But I think another part of it's just retail participation. They're seeing these big gains, whether it's, people on Twitter or if it's, or they're reading about, the prevalence of 0 days. And so I think they just get interested and they want to see, what are these options all about? And so I think that they're drawn into it.
So one of the things I think is going to be interesting to me is because I hate 0 DTE options for retail. I really
Why?
do. Because I just think it's one of those things where it encourages just the flip of a coin for most people. It really does. I mean, just like I tell people all the time, look, if you're going to be a day trader, I don't like any of those terms, right? People say to me, are you a day trader? Are you a swing trader? I'm a trader. If I get out of something in a day, fantastic. If it takes 28 days, whatever. I mean, that's my trade. I'm looking for my target or my stop, right? Now, obviously, there's another factor when it comes to options, Bret. And when we're looking at this particular data set from your survey, is there any component of that survey that shows profitability versus blown up accounts in the different types of options or on the whole?
So in the survey, no, there's no specific, there was no questionnaires around profitability or whether traders have blown up or not. I guess the closest stat we had to that was the percentage of respondents that have been trading for X number of years. And off the top of my head, it was like 61 or 62 have been trading for 4 years or more. And I believe the other one was close to 25% for a decade or more. So it shows obviously people that stick around, learn how to handle and harness the power of options without causing catastrophic damage to their portfolios. They do stick around, but the 4 years or more really stuck out to me as a key date, a key year, which would indicate right around COVID, when they started trading at the very minimum or beyond that, and they're still trading today. So more than half of the respondents were in that category. So that kind of stuck out to me as they're staying around, whether there's and so much has happened since 2020. I think you guys too. We're in this day to day, and so it's kind of easy to maybe forget what we've gone through over the last 4 years. But we went from a bull market to the COVID bear market, and back to a bull market, and then an inflation inspired bear, and now we're at all time highs. So that's a lot to happen in 4 years. And so retail stuck around though, and they keep learning, and they keep learning the hard way, and getting the rewarding side of it too. So they're sticking around, it looks like.
So that was sort of my follow-up was going to be, what's the length of the survey? So if it's kind of like from COVID on, I don't need to guess at the exact start date of the survey, but this seems to me to be like, if you guys were doing a 10-year study, this is like the 2-year mark, right? Where you say, okay, this is what happened. Because I imagine this, by the way, I'm pulling this out of my ass, but I imagine this scenario. And Jim, if you go on your Twitter and retweet what I just tweeted, that would help. I imagine a scenario that
You're from Chicago. Stop trying to be fancy.
I imagine a scenario.
It's a scenario. Hey,
I imagine a scenario where you make it. You know how long I worked on my non-regional diction. I imagine a scenario where people I'm not going to say it was easy to make money during the pandemic, but one of the things that I think Jim learned this as well, but I learned during the tech bubble, okay, was that I was watching people that I knew I was empirically smarter than make a lot of money on day trades in tech stocks. And here I am working in the futures industry. I'm like, look, I'm busy. I mean, these guys are coming up and they're running to my desk and they're going, can I use your phone? I got to sell Red Hat. And then they come back down an hour and a half later. I got to buy back into Red Hat. Can I use your phone? I'm like, what the F is going on here? And these guys were like, yeah, they made like $4,000 during the day because they were clerks, and they made $25,000 in their day trading in stocks. So I look at the COVID situation, and I think to myself, how many of these people bought like GameStop call spreads over and over again, or Hertz call spreads over and over again? And because they were call spreads with expirations, they never lost the money like those outright longs did. Is that crazy to think? Because now they'd be saying, okay, now I can trade options for the next 2 or 3 years because I got a big bank.
Sure. Yeah. I would think that a lot of people did learn their lesson the hard way at the last bear market. The reality is social media has a way of like drawing people in, but also you start to compare like, oh, I'm long, whatever, ARK or Tesla or any number of those growth stocks that exploded. And I made whatever 20 or 30% in stock, but these calls are up, whatever 500%, 1,000%. I want those types of returns. And I think we even kind of see a little bit of that mentality. I know this wasn't really part of your question, but just generally speaking, I think we kind of see a part of that mentality still exists in the markets today. People want that immediate type of home run type of return just because we've gotten so used to seeing such violent swings, really, even though, you look at something like the VIX and it is low. But I think we've gotten so used to seeing these markets swing in such violent fashions in both directions that sometimes, when it's just slow chugging in a stock, it can be, kind of boring. And so I don't know. I think that to get back to your actual question, like, yeah, I think some of the newer traders in that era did probably learn the hard way because for a long time they just kept getting rewarded over and over and over for their, their willingness to take on risk. And then, in 2022, basically right at the start of the year, things kind of fell apart and kept falling apart for most of the year. And that really saddled people with a lot of losses. Yes, they might have had just lost the premiums instead of losing their, a bulk of their investment in common stock. But if they had too much of their portfolio allocated to those calls, then the destruction is just as bad, and likely much worse.
So, Bobby, okay, I have a question for both of you. I'm actually going to start with you because you already expressed a distaste for the 0 days to expiration, which I have no idea what I think about 0 days to expiration. But if the stat that Bret just gave us, that 62% of the users are still around over the last 4 years, that means all the shit we're doing as far as trying to encourage retail traders to trade responsibly, to protect losses, to not be idiots. It seems like it's working, Bob, don't you think?
I don't know. I mean, 62% definitely surprised me.
Yeah,
It
me too.
surprised me, right? But if you look at the market since COVID, where's the drawdown?
Okay.
Right? I mean, just put up a stock chart and put up a S&P, right? Where's the drawdown? So Bret, you don't know this. Jimmy, I think, does. I spent 6 years as a part of an investment committee on a fund of funds, a futures-based fund of funds. And we would get 20 to 30 documents a day, performance documents, right? And my lead role was emerging managers. So emerging managers were people with 3 years of track record or less, right? So last year, most of the COVID people were still emerging, right? And the first thing we did with those people is find any sort of a drawdown, a losing streak, any sort at all, and then try and discern whether they changed strategy or not, something we call style drift. And if you look at a stock chart, for the most part, there would be no place to look for style drift. That's why I say I'm not sure. Bret, am I crazy?
No, I think it's also difficult to discern how much retail is involved in 0 day versus on an institutional basis, and parsing out that volume is difficult. And I, I'm kind of mixed feelings on 0 day too. On the one hand, it's one of those things you could put in
It's fun.
$100 and walk out with 1,000, but there's also a sort of a kind of a casino feel to it.
Yeah, it's fun.
And
Yeah.
yeah, they are fun, and if you have the funds to do it in the right way of allocating to it, they can be a great way to take advantage of intraday volatility when you think you have an edge. But for especially inexperienced retail, 0 day is one of those things where they typically don't have the understanding, particularly around how options, like the nuances and how options, what really makes them move intraday on those micro short-term bases that, and I think that lack of education and experience with them is ultimately what burns them. It's just, if they're too improperly allocated to it, where the pain really is.
But so I understand fully the risk to the individual traders trading things that they might not understand. Is there a big, huge systemic risk on 0 days to expiration options? If everyone in the world's trading them, I mean, it might exacerbate intraday moves, but it's not going to start any big sort of 25% stock market cascade, is it?
I'm of the opinion that it wouldn't, but that's also, we haven't seen it. And if anything, I think there's an argument to be made that 0 days can also dampen intraday volatility. Obviously, that's not a blanket statement for all days.
No, of course not.
There are days that it exacerbates it too. But sort of when we see that pinning action around key levels, I think sometimes it can kind of hold things together.
We've seen it. Yeah, right. That's interesting. Bobby?
Yeah, so I think that's a great point, Jim, because no, I agree with Bret that there's not really a systemic risk in these things. To me, it's like it's just sort of bringing another tool to bear, right? Just bring something else that people might want to trade, and you can completely expect it. It's sort of like restaurants bringing out appetizers, right? I mean, you got a restaurant. It's like, well, I'm about to have a meal and probably split a dessert. Yeah, but look at these apps here. These are good. These are good. What I worry about is retail traders, and I worry about them, because I'm very nice and empathetic, unlike Jimmy.
Right.
And I worry about them and think, well, you're going to fill up on appetizers here, and it's one of those things I would not. And to what Bret said, okay, zero DTEs allow you to not really understand options and trade them anyway, in my opinion. They're fun. They're really fun for guys like us, and I'm sure they've been fun for retail.
Yeah, but there's very little managing theta over a long period of time.
No, data's gone from it, and I mean, how important is delta really when there's only one day left? But people don't understand that. And, because of that, they'll go, well, I'm killing it on these zero DTEs. Let me go put on a monthly, credit spread and see how that works out. Yeah, see how that works out. It's a little bit different. It's a lot different, as Jimmy can attest to.
Yeah. You want to get to markets?
Yeah, let's do that.
Let's jump into markets.
Yeah, that's what I want to do too. You want to talk about utilities? My favorite non-sexy part of the market. No, people can make good money on utilities. I'm curious as to why you want to talk about utilities. Let's go.
Utilities is truly it is truly the most unsexy sector in the S&P.
That's great. Yeah.
But it's been a good performer this year. At one point, it was I think the best performer quarter to date, which were a little over 2/3 of the way through the quarter. It was the second best performing sector in the S&P this year. I think it's now the third best. I think it's sitting behind tech and communications. But nevertheless, it's still performing really well. And it still has some positives going for it. So back in May, I've updated the data a little bit, and I did it in the charts as well that I passed along. But when I did the data and did some research on it in May, it showed that there was still some catalysts at play. And this is a technical look at it, which just really shows how it had been, it's struggling for quite a while. This is a weekly chart, by the way. Struggling so much to get its head above water, and then it finally started putting in some higher lows, and then it broke out over both static resistance and that downtrend line, and now we're back just under 2023's high for last year, and utilities still have some promise. I think that in the short term, and we've been seeing it over the basically since the start of June. I think utilities could use a little bit of a heat check and pull back a bit, because we ran like 5 weeks straight. I think 5 straight up weeks, and that's just a more a chart we have to disassociate from any other platform. So we do it on our own. But there is a third chart in there on the valuation, which is the forward PE ratio for this year. And when we look at the valuation of utilities, there's still kind of a compelling case to be made. It's set for its best year of growth. I believe it's like about 10.5% earnings growth this year. It's best year of growth since 2009. And I think where the opportunity may lay is in a pullback, because the sector's working off 3 straight quarters of double-digit earnings growth. And this upcoming quarter is expected to be less than 1% growth. So I think we might maybe see a little bit of a heat check, a little bit of a pullback, but then after that, we return back to solid growth. I think 3 out of the next 4 quarters are expected to grow 7% or more. 2 of those quarters are close to 10%. And so I think when we kind of look at the earnings expectations and then combine it with the valuation, which right now trades at 17 times forward, over the last 7 years or so, it's tended to trade between 15 and 21 times forward. So we're kind of in the middle of that range on the bottom half of it. And I don't know. When you look at it across the board, I think the fundamentals kind of make sense. And for probably once in utilities' lifetime, there is actually a growth catalyst at play, which is the whole AI boom and these mega companies needing more power, and the computing power of AI and the GPUs is pretty robust. And so I think for once, it's not just a defensive positioning. The world is ending. We need solid cash flows and dividends. There's actually a catalyst behind it that's more growth related. And then when you throw in the idea of lower rates at some point from the Fed, then I think utilities just have one more catalyst in their sail.
So you just mentioned dividend low rates, which
Yeah, we lost him again. So let me ask the question I was sort of ready to ask you about this. Obviously, many people get into utilities for dividends, right? I mean, that's sort of the story that people always tell is that there's a good dividend and blah, blah, blah. And I don't know. Well, I could see what the last dividend was, but I didn't do the math on the dividend yield. Last dividend was 52 cents a share for the XLU. And I look at the chart now, and utilities, the XLU had a pretty bad day today, but it doesn't seem to me like it broke any sort of buy the dip fears that somebody might have. Like I like buying the dip in utilities right now after the day it's had today. And I'm looking at a daily chart to make that conclusion because we have a pretty solid double top on a utilities chart that I'm looking at my charts on the left here, takes us down somewhere to about 68.19. So even at the current levels, that's a pretty good swing trade there, or day trade if it ends in a day, right? So if I look at utilities as a sort of from a fundamental view, I think to myself, I think inflation is kind of ramping a little bit. I don't think it's, despite this morning's numbers, I don't think that that's going to be the trend over the next few months. And because of that, do you think despite this chart, utilities will suffer? Or you not have an opinion on that? One of the beautiful things I like about technical analysis is you can answer, I don't care.
No, I mean, to be fair, I personally, I prefer to blend the two. I like to look at the fundamentals and the technicals and put them together. I think for me personally, my viewpoint with interest rates is that a cut from the Fed is going to be a when situation, not an if. Multiple meetings now, we've kind of gotten the understanding that the committee's not looking at raising rates, and I think Powell even cited that specifically today. No one in the committee has that as a base case, and so.
Mm.
I think that the rate cuts for the market in general is a when, not an if situation. And that is kind of a sort of, it's a tailwind, but it's, kind of ebbs and flows on how strong it's going to be at certain times. And I think for utilities, it's kind of the same play. I think as long as investors know that a rate cut is coming at some point that works in utilities' favor, but at the same time, I think it's got enough other catalysts working for it that it doesn't play as big of a role as it may usually do.
What does it pay a dividend, the XLU?
XLU pays 52 cents a share, which I could do the yield pretty quick, but it looks like it's somewhere around 7% maybe.
Oh, shit. That seems awful good, particularly if we're starting to move to a lower rate environment. I like that play a lot. So
yeah, I should probably do the math because I'm probably wrong on that, but go ahead. That
seems odd, but what is that level on the upside? Because to me, it seems like if it reverses that red candle and closes above it, that's me the indicator that it's going higher. What is that line on the top? 72.27.
It's about 72.50, I believe, is roughly.
Yeah.
By the way, it's more like around a 1%.
Oh, okay.
So
yeah. So yeah, that's interesting to me. All right, Bob. I don't know why my microphone cut out. I apologize for that, by the way.
That's all right. It goes to mute for some reason, but we're figuring it out. Tim McLean on there. Utes are the backbone of AI. Love them. That's interesting. So let's talk about thanks for that, Timmy.
Yeah,
that's really an interesting point because AI we don't talk about this enough. AI is obviously going to demand electricity generation. Now, I think the counter to that would be the grid isn't ready, which isn't necessarily going to be good for utility stocks, right? Do you have an opinion on that at all, Bret?
I wish I had a better opinion for you on that. I'm not sure. I don't know what the grid capacities would be, and what companies. I don't even know which companies would struggle with an issue on that front.
Jimmy?
No, I don't. I've been playing the AI thing and the electrification thing from the metals side of it. That's the thesis for my copper trade, the thesis for my uranium trade. So just watching Bret say this today, like the utilities. Oh, and Tim McLean saying that the backbone or the utilities. This is all news to me and good news to me because I like it a lot. But I have no, the powers. We need a lot of power.
All right, so let me ask you something different, Bret. Do you have an opinion on the tech sector at all? And the reason I ask you this is I saw a really interesting comment recently. I don't know if I agree with, but I've started to explore it. And Jimmy, the next time I hit you with something you think is too smart for me, it's because I'm exploring it. It'll probably be on the tech sector.
You got it.
There was somebody who ran a hedge fund. I've got it in my notes over here, but I don't have time to look at it. Said AI is actually going to be wildly deflationary for tech more than anything, which will hit.
I know. I read that same thing.
You read
That's
that
interesting.
too?
Yeah.
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 Because they basically said that tech is costly for companies to apply into their businesses because writing software is costly, right? Software developers are costly. And that's one of the things AI already does really well is code, is program. Do either one of you have an opinion on that? Jimmy, I'll go to you first since I'm hitting Bret with that out of nowhere. He's gone again, Bret. So it's completely you now. He's getting upset too. Look at his face. He's getting very upset.
Security's going to get called again.
They're going to call security to the office. Go ahead, Bret. You have anything on that at all? And then what do you think technically of the tech sector?
I think tech continues to trade really well. Tech has always been I feel like a game of the haves and the have-nots. And during great, the ends of bull markets and the great trending markets, we can see, especially when we had such low interest rates, a lot of tech names can get that wind underneath them. But I mean, look at the market now. When you look at Nvidia, its size has not slowed it down one bit. To see a company with a market cap in the trillions moving the way it has been moving just this year alone is really, really impressive to me. And I think it's really early in the AI game still. I mean, we've been inundated with AI information and news and stock related developments for the last feels like 2 years now, but we're still really early in terms of figuring out what AI can do and how it'll affect not only just the tech sector, but numerous industries, probably every industry it will impact at some point. And, at some point, yes, I think there will be some deflationary measures to it. I think it'll just be a question of where do we pick up the slack and where do companies reallocate, excess funds to, and sort of what opportunities does that create in the future?
But it can't just be Nvidia that's the only AI play right now. What are the other? I mean, if that's the case, and one company is going to be this huge winner of it, what are there huge barriers of entry that other people can't flock to this arena? Are there other names out there, Bobby or Bret, that are going to be the next Nvidia? Where are they?
And Tim McLean might have one as well, so he can chime in if he does.
I'm in. Tim, Bret, you got anything?
For right now, NVIDIA is the undisputed leader of, basically producing the products that are needed to use these applications. And, it's funny because I remember I can't remember the year. So that's a funny way to start in the sentence, but I was at an NVIDIA conference, one of their GTC conferences years ago. It was probably 2018 or 2017. And they were talking so much about AI. Jensen was talking about it. They had their keynote presentation based on it. And this was way before, AI has become what it is today. But at the time, I remember the stock, NVIDIA shares were performing really terribly on the back of that inventory glut of chips because of crypto. And the crypto market was going down and the stock was underperforming because of that. But it sort of planted that AI seed in my brain from what NVIDIA is capable of doing once we start to see some scale. And unfortunately, had I known just how important it was going to become, I wouldn't need to ever work again, but I didn't know that. So here we are still working. But for now, they are the leader. At some point, I think the AMDs and the other chip companies will make a product that maybe doesn't compete on like a head-to-head basis, but competes well enough where other companies will go to them and NVIDIA will see some pricing pressure and their margins will come down. And we're not there yet, clearly. Stock has been an absolute monster, but at some point we'll get to other winners in the chip space. And I'm more curious to see what companies are going to do with the AI and the winners that'll sort of emerge on that side of things. I think right now we're seeing the hardware winners, which is, which is fine. I'm more curious to see the software side, who's going to emerge, beyond here, start leveraging AI for real value towards other companies,
So
towards
what
their
the
customers.
Apple news today was basically just that Apple said, yeah, AI is cool. And then they rallied, whatever they rallied today, right? What was the story about Apple? I have Apple, by the way.
Man, Apple was that. I honestly, for me, it was refreshing for me to finally see that stock trading to new highs. It
Yeah.
felt like a weird bull market to not have Apple participate, but yeah, they had their WWDC event on Monday. The stock fell, I think it was almost fell 2% that day. Everyone kind of shrugged off the event, and then back to back days of just pure explosive rally. I like to see it. It was fun. That was a beautiful breakout, and hopefully it can continue to lead. But yeah, Apple's trying to work AI into their customers' hands and put it in the iPhone, put it on the iPad, and make it more incorporated into people's day-to-day lives.
Bobby, can you say what the name of that thing? Tim McLean has given us some good info. What was that first stock he said? CDNS is
Yeah,
one.
Cadence Design Systems is the one that he's talking about. I'm actually looking at their financial highlights right now, and it's really not bad at all. I mean, their diluted EPS is $3.91. That's pretty good. Cash, they got $1.16 billion. Debt to equity is only 18%. Seems high, but not really that high for this particular type of stock. So, I mean, it seems like a structurally sound company. What I don't know is specifically what they make, and maybe Tim can chime in on that too. But another one that I like is ASML, because I think ASML really performs well when NVIDIA performs well. Now, they're a Dutch company, so you're trading the New York registry stocks if you're trading those here. But they don't have competing chips. They have complementary chips, right? They have complementary hardware and some software to NVIDIA. So there's actually going to be some companies that are deep into AI that might use both for different things. So I've always liked that one as well. But this Cadence is interesting to me. I haven't looked at it yet.
So here's my question. I think what we're talking about here, and let's break it down, is that the tech trade, like, I don't know if you read Larry McDonald's book, Bret, he contends that this 25, 30-year period of interest rates held inorganically low, favored growth, favored tech. This new environment coming for the next 10 or 20 years is going to be higher rates because inflation is somewhat embedded. And that's going to really reflect positively on the commodity sector, on things that do well in that sort of environment. The caveat, in my opinion, is that you can look at the tech sector as a whole, and then you can tease out the AI names of it because that's the big thesis that could drive things. But the rest of tech, I'm not that interested in. Are you?
It's interesting. It's not yes, it's not no. It's sort of it depends, I guess would be my answer. I think when you look across the board, you see some of these companies, AI related or not, if they have the free cash flow and the basically if they can run their company without having to borrow, I think those companies will do just fine. So free cash flow positive companies with strong balance sheets. If it's a growth company that has to borrow to survive, they can't turn a profit, they have negative free cash flow, that's going to be a problem for them. These rates are going to continue to chisel away at their financial powers. But you look at these bigger companies, especially some of these mega caps, and the margins that and I don't just mean Nvidia, but you look at the margins at a Meta or a Microsoft, or you look at even if you go into cybersecurity and look at some of these companies and how much they're growing and their cash flows and how strong they are. Lower rates would help them for sure, but they don't need the lower rates to do well. So I think
Bobby, do you
it's
agree with
going to be
that
a
or no?
company.
I do. And actually, Tim just said what I was trying to say in plain English. Cadence Design Chips. ASML makes the equipment that makes chips. So sort of like what we talked about in the rundown about, some of the companies that support the ags is what we talked about in the rundown. But ask me the question again, Jim. I'm sorry.
No, just my thesis about the tech in general could struggle in the coming decade, but the AI names could still be rockets in the coming decade, correct?
Yeah. So it's So I agree with what you're saying, but it's hard for me to agree with that particular statement. The reason I say that is because whatever is new now is going to be tech.
Yeah.
Like whatever comes out next is tech. I really doubt they're going to come out with a new form of pig and we're going to want to get long hogs because of the revolutionary pig that, makes triple the bacon with quadruple the flavor.
You're getting me so hungry right now, by the
I'm
way. I'm
starving.
starving. I haven't eaten
Absolutely
since like
starving.
8:30, right?
Everything I do is I always do food analogies. It comes with a vowel at the end of your name.
Yes.
But yeah, so you look at it from that perspective, it's like everything is going to be tech. And younger people have come to me and have said, I'm starting to get some money to invest. What should I do? I'm like, I really can't tell you to do anything, but just buy the QQQs. And if you get interested in short-term trading, let me know.
Yeah.
Right. I can talk to you about that, but it's like they used to say just index to the S&P. I don't even think that's the thing anymore, considering that the NASDAQ composite is 60% tech, cap weighted, of course, and the S&P is 33% tech, cap weighted. You're almost, if you think about the recommendation used to be a 60-40 portfolio, the QQQs is almost 60-40, because nobody really wants to be in bonds for the long term anymore. It's all short term duration stuff with the bond market. So, I mean, that's my thought on that.
So that's interesting. And I probably agree. My daughter, when she got out of, when she started her big girl job, 8 years ago, I just said for the first 5 years, just pump everything into tech, take as much risk as you can. And only after the 5 years do we start reallocating a little bit and reallocating future contributions, just because she's a kid. If you're going to live to be, if you're not tapping into this for 40 years, you're probably going to be good with tech. Yeah, Bob?
That brought me to a question about the survey again, Brett, that I wanted to ask, but I didn't. Were there ages discussed in there? Because what Jimmy just said, like, I would tell young people, yeah, mess around with the options, do whatever you want, go zero DTE. You're working, right? I mean, it doesn't matter if you lose $5,000 next week, you're going to, as opposed to a friend/relative I had a while back that said he was really augmenting his retirement by selling naked options. And I tried to talk him out of it. And then the real estate crash happened, right? The mortgage.
And that talked him out of it.
Yeah. And all of a sudden he was like, yeah, I don't think I should trade options anymore. Were there age metrics in your survey or no?
There were age metrics, kind of looking through it now, but yeah, none that jumps right to the front of my mind. It's quite a bit of data to look through.
I would assume it's more young, more young than old. I would assumption.
It skews young, but it skews in obvious fashions as well. I think for a big part of the way we did the survey was we would ask certain questions and then have it sorted by the age that they responded with from the beginning of the survey. So it would say, oh, how long, if you've been trading for, if someone said they'd been trading for 10 years or more, that obviously skews higher in age,
right,
just simply because of the way the questions are framed. But yeah, it was a component.
Was there a question about what percentage of their investment portfolio they use as risk capital with their trading strategies? Did you break it down like that too?
Yeah, the way that they did it was the way that the survey was structured was if their account is allocated into other assets as well, like mutual funds, stocks, crypto, and that sort of thing. And actually, it was very, very high towards skewing into funds and into stocks, and that was kind of a nice change, just versus seeing someone open up basically a brokerage account, options account, and just saying, "Oh, I have $5,000, I'm going to YOLO it." It seems to be a little bit more prudent with the risk. Like, hey, I have $5,000, I'm going to do 4 in funds, and I'll do 1,000 in options, and see if I can have any success there.
I think the moral of this story, Bobby, for you and I is, we've been preaching sort of, risk management for these last 10 years. Maybe someone was listening the whole time. Surprise, surprise. No?
Well, I don't know. I mean, again, we talk about if you've been trading for 10 years, you've never really seen a bear market. Just COVID.
No. 10 years. Yeah, that was a 36% drawdown, depending on where you were positioned.
Yeah, right. But it was the smallest of the last 3 actual crashes, right, in terms of percentages, and it flipped right around. I mean, anyone who believes that you always have to buy the dip certainly was not disproven by the 36% drop in COVID, unless
yeah.
they started buying 2% lower and scaled into their whole position by 8% lower. Then maybe they'll learn their lesson. But that's one of the problems we had looking at emerging managers is, was there a period of time? I remember somebody coming to us, and I can't pinpoint the section in time now. I should prepare before I tell this story, but it had just an unbelievable record trading gold futures. And then I looked at the period of time he started, the period of time that he came to us for an allocation. It was straight up.
Everybody's a genius in a bull market.
Yeah, exactly. Yeah. So anyway, Bret, do you have another sector other than utilities that you've been keeping a close eye on for whatever reason?
Yeah, the one thing that's actually really stuck out to me is if you go back, this is actually great because of where we're lapping from a year ago. Go back a year and it was the Magnificent Seven and Magnificent Eight, if you want to include Eli Lilly in there. But that was like the whole market, basically. It was the 8 biggest names, and they did all the heavy lifting. Mega cap tech was responsible for all of the gains in the S&P. I mean, maybe perhaps not literally, but it certainly carried more than its fair share. And now you look at the market now, and it is very clearly it's a sector rotation story. It's a stock pickers market. We have I think it was 8 sectors are up 7.5% on the year, and that was coming into this week, and they've just performed really, really well. And so I think as long as investors are looking at decent fundamentals, but to me, possibly at this moment, just more sound technicals, then I think they'll be okay.
Tim, our super fan here, has another question. I think this is a good question because we all remember the Black-Scholes model used to have interest rates as a component to it. And then everybody just kind of took it out because there was no interest rate to speak of. But any thoughts on interest rates and how they affect option buyers, Bret? And Jimmy, if you have an opinion, please.
I do, but I have to let Bret go first.
I mean, I don't think on just your everyday average Joe, no, I don't think they have a meaningful impact.
No. So particularly the 0 days to operation, because where I do think they have a meaningful impact, and that's row, right? Isn't that the Greek for the interest rate portion of it? I do think that if you are a market maker in options and you are getting paid 5.5% on your overnight money, it will provide you incentive to lower the price of the option you're selling to the person who's buying it, because you can take that cash and invest it overnight. And I think that that's fascinating. So I do think, and again, for the last, how many years have we not had an interest rate? Probably really 15 to, they've been low. So I think this is an interesting time too. So also when interest rates, so you guys have to help me walk through this too, because in periods of huge low rates, I always think that then the regular person who's looking for yields has an incentive to, buy and sell calls, or, try to eke more interest rate by selling options, which is the opposite of what I just said about the market makers having lower prices because of the higher interest rate, which is a greater factor. Do either of you guys have an opinion on that?
Well, I do. I mean, if you, even from a retail perspective to a certain degree, institutions, when you're sitting in a situation where you've got 3-month yields are somewhere around 5.39. Actually, they might be around 5.50 right now, 3-month yields. I used to cover a guy in the pit who it was quarterly contract options that he sold, and he sold a lot of them. And you would have to take that calculation into account. You would have to say, okay, I'm selling it for this particular premium. What is that? Like, what's my risk and what's the yield on that risk? Right. And if the yield's 3%, why would you do that when you could buy a 3-month bill and have zero risk? I mean, you need to like double it. You need to double the yield to take the risk, especially on a naked option. Yeah. Right. Yeah. You need to double the yield easily. So that would bring the yield to 11%. That's a good yield over 3 months. I mean, granted, it's extrapolated, right? It's amortized that 5.5%. Over a year. So it's really more like a quarter of that, but still you have to do that calculation.
Yep. No, that's what I've always wondering too, because I did think there was a time where there was so much reach for yield that it was actually depressing option prices, where it should, higher interest rates should in fact depress So again, it's very, very confusing to me, and I'm never really sure how it works. What
I
else?
think it's short term versus long term.
Yeah, that's probably right. What other topics you want to hit before we go? We got about 3-4 minutes left.
I'd like to ask Bret if he has an opinion on energy, and here's why. I am of the opinion we are in a reflationary regime right now. In other words, the economy is getting stronger, not weaker. It's not a blowout economy. But when I look at the totality of the data, I still see slight increase in the economy strength. GDP is going to be lower, but manufacturing PMI is looking strong. I don't need to go into all of them. Jobs are still good. I'm still going into all of them. What do you think about energy? Because in reflationary regimes, if you do an equity sector back test, energy performs well. Not the case so far.
Yeah, not the case not the case over the last few months, but man, what a start energy had to the first quarter of the year. I mean, it was truly on fire. If you look at the sector, it had broken out to, I think, multi-year highs. I mean, it was trading really, really well. I'll be honest, the pullback here has been deeper than I would have anticipated. After we had that breakout, I would have really loved to have seen it, firm up and hold up and continue to at least be a little more constructive. I'm looking at the chart now, it's above the camera, and it's not horrible, I guess. It had a huge run, consolidating lower, maybe giving up, maybe not quite half of its rally, but I'd love to see it firm up and become a better story for the second half. And it does seem to have the fundamentals that support it. But that being said, I don't know that it's necessarily a go-to sector for investors. It sort of feels like one of those names that has been sort of left by the wayside. And I think that's partly to blame on tech, just in general over the years. I don't necessarily mean this year or recently, but it seems like there's so much infatuation with tech and the big names in that group that a lot of other sectors kind of get left off the discussion, and they, people don't go to them as often as they used to.
Bobby, what level in WTI is going to make you think the race is on to the upside? I know both of us are kind of waiting for an up move. What do you look at now?
Let me pull it up right away because I don't have it up. I actually got the NASDAQ up here because I'm fascinated by it. But it was in the mid 75s the last time I looked, and let's see where it is now. So I'll give you two levels because I had us in a pretty convincing daily downtrend. And it's a roughly drawn channel. It's not a perfect channel, but it's a down channel nonetheless since about mid-April. Okay, 2 days ago, we broke out above it. Now, the last time we did that, it failed back into the channel and then collapsed. That breakout date was May 28th and collapsed down to the bottom of the channel about June 4th. We broke out on June 10th. Yesterday, we did nothing, and today we're closing back above it. But we have basically the 200-day moving average in the way at about 79.68. And even though I don't take any signals off the 200, I'll never ignore the 200, even as flat as it is right now. So I would say, let me just round it to 80. Yeah. If we get a daily close above 80 and 80 holds, I'm buying with both hands.
Hey, that's funny because that's my level too, but I didn't go at it as technically as you did. I looked at this chart and said, closed one eye. I was like, 80 is the level. Closes above there. That's
Bret, you got a level on there, or you just kind of look at the same thing we are?
Man, I wish I was able to write it down and then hold it up. 80 would be my mark too. Puts it back above all of its moving averages, gets it out of that down channel. That's what I would need.
I'm thinking as well. All right. You've been a great guest. Tell the people where they can find you.
I'm on Twitter and LinkedIn, just at my name, Bret Kenwell. So that's where I hang out.
Okay, he's Bret Kenwell of eToro, and that's been an excellent conversation. Thank you guys for joining us. Remember, none of this stuff works without the support you guys give us, the DMs, the retweets, all the support. Thank you a ton. Remember why Bobby and I do this. Bobby and I were in mainstream media for many, many years, me almost 20. There you can't really give honest opinions because there are sponsors breathing down your neck. We want to get to an arena where we can say whatever the hell we want. I don't mind being wrong. I like being right, but I hate being told what I can and cannot say. Thank you guys for being part of it.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.